Good day everyone, welcome to Earthgam. In this video, I'll discuss three investment options for an European NRI for investing into the stock markets. Specifically, we'll cover mutual funds and ETFs instead of direct stocks. My name is Sharon Sharkar and I am the author of Earthgam. Earthgam is a website providing you with the right knowledge, tools, and one-to-one guidance to create, manage, and execute your portfolio. Before getting started, please put in a comment below about what you think is the best thing for European NRIs to do in terms of investing in the stock market. Our objective of this video is to provide three options which we are now going to cover one by one. First, this is the simplest option, investing directly in the Indian stock market. What are the advantages? First and foremost, historically higher returns compared to most of the other countries. And when I say historically, this has been true for the last 15 to 20 years and even more true in the last 5 years, where the returns in the Indian market has been fairly high compared to most of the developed countries and even some of the emerging markets as well. The main drivers for this are India's economic growth, favorable demographics, and robust domestic consumption. Basically, the economy is growing fast, the consumers are young, and they have a high disposable income, which is not only increasing but people are spending money to buy goods and services which was not there earlier. The next part we're going to cover is diversification. So if you're based in Europe, and you're investing, so you have access to the entire developed markets with you. So starting with the European market itself. However, India, along with the BRICS nations, forms under emerging markets, and diversification into emerging markets has the potential of higher returns compared to developed markets. And the most important point here is that unlike US based NRIs, who are subject to something called PFIC tax, where their investments in mutual funds and ETFs outside the US are subject to tax based on unsold, that is, unrealized capital gains. This is not applicable to any European country. Rather, it is not applicable to anywhere outside US. So, investing in the Indian market via mutual funds or ETFs does not require anyone in Europe to pay tax until and unless they actually sell those investments. So, these are the three main advantages. Coming to the disadvantage, the main point here is if you're investing in India, you're converting your European income, which is denominated in euros, to rupees, investing that, and then spending that money. If you spend it in India itself, you're going to spend it in rupees, but if you repatriate back to Europe, you're going to repatriate in euro, and due to which any depreciation of the rupee against the euro will reduce your income. This is the point of FX risk. Let's cover this. So, euro was launched on January 1999. Since then, it has risen by around 40 to recently around 89. It is around 25 years. This 102% return, which you can see on this chart, is around 3% of average annual growth. So this means that if you are getting 12% from Indian equities and then you repatriate that amount back to Europe, anywhere in Europe, then your return is only 9% approximately. So you're going to lose 3% due to currency depreciation. Now, in recent trends, the euro may not have gone that much up against the rupee, but this, if you just go by historical averages, you can assume that 3% is a figure for long-term investors in terms of rupee depreciation versus the euro. So that covers the point of FX risk. Next comes market volatility. Emerging markets, India specifically, are generally more volatile in terms of movement. So rises can be high, falls can be sharp. So in both cases, the compared to developed markets, the volatility of emerging markets is much higher. So these are the two risks that are there in case you're directly investing in India. So what do we come as a conclusion for this particular option? You're getting good returns, but you have to keep in mind the forex movement, and it is suitable for investors who are there for the long term, and when I say long term, I mean decades, and they are strongly of the opinion that INR depreciation, that is rupee depreciation, will be offset by the potential of higher market gains in India. So this is the first option where we have covered investing directly in the Indian market. I'll move on to the second. This is the simpler one where you are staying in Europe. Let's say you're staying in Germany, Netherlands, Italy, Spain, wherever, and you're directly investing in the European market itself. So it's fairly straightforward. You are just like an Indian investor invests in Indian stocks. You're a European investor, European investing in European stocks. So obviously there's no forex risk because you're earning in euros, investing in euros, spending in euros. That's straightforward. Second is, since Europe is a developed country, rather developed region, and all the countries have layers lower volatility and uh, price movement risk compared to the emerging markets. And since you're sitting there, you're living there, you're aware of the local economy, the conditions which are there, and you know the companies and the brands which are operating. So even regulatory environment, if you think of it that way, you know what the regulators are talking about, what the taxation rules are, etc. That is fairly straightforward. So this is the advantages. Coming to the risks. Next, the first and foremost risk is much lower equity returns compared to the developed emerging markets, especially India. This is due to the economy being mature, growth rates are lower. Europe has been notorious for the last few years for lower growth rates, and there are less advantages in terms of market efficiency to get more the market returns. So if you understand this particular chart, this shows the top stocks in Europe, specifically the Euro 600, the returns for that for the last 5 years. So this, when I say last 5 years, this is specifically just before COVID. So I put that one on top, followed by the S&P 500, which shows the US market returns, then FTSE 100, which is UK, then DAX, which is Germany, and CAC, which is France. So as you can see, the if you simply look at US versus Europe, entire Europe or each of these individual countries, the point-to-point return in the last 5 years has not been good for Europe. We obviously know that in the US, the stock markets have gone up pretty high in this period, but the European returns have not been very good. And this becomes worse if you add Nifty to this, that is India to this. So here again, I'm showing you Europe, S&P 500, that is the US, the UK, and Nifty. Nifty has practically doubled in this period, while the European index has grown by only 25%. So that's not a lot. So that's the main point here, that the European market returns in the last 5 years, point to point, has been pretty less. So this is the first point that we need to cover. This is lower equity returns. And the second point is related to this. Europe has been having a lower interest rate. In some cases, the interest rate has been negative in central bank, and that implies a lower equity return compared to other places. So for whom is this suitable? So if you're a conservative investor and you are what a sort of like a safe equity exposure without emerging market concern risk, so that's something that can be you can look at. So more capital increase will be less, so capital preservation will be more. Or if your goal is in the short term ideally you should not be investing in equity, but in the short term as well, if the fluctuations are less compared to other countries, then something that is something you can look at. And specifically, again, a quick reminder, we're not talking about direct stocks. This will be through mutual funds or ETFs. And there are multiple options out there. Now, before going to the third option, I would request you to please click the link in the description section to join our WhatsApp channel, get notifications about the site content and upcoming webinars. Now, moving on to the next bit, which is investing in global stocks through an European fund. In this particular case, what we will do is we are going to invest in global ETFs or mutual funds, whichever the case may be. Europe offers, irrespective of which country you are in, these you get a lot of options where you have mutual funds, ETFs, which are globally diversified. So you can get a whole world index fund, you can get a developed market index fund, you can get developed or emerging separate. So all of those options are present. So global diversification, it's good because you no longer have market specific risk. So it's buying the entire market, developed plus emerging. You don't have any specific country specific risk. That is no longer there. these ETFs typically hedge the forex exposure. So irrespective of which country they are investing in, whether in the US, which is USD exposure versus the euro, in emerging markets or whatever, they are going to hedge that exposure, and that would reduce the completely eliminate the currency risk, not just reduce, eliminate the currency risk, so that it is the returns that you'll get will not be dependent on how the euro behaves against against the global currencies. And of course, you have a lot of options. Let's say you want to from specific high growth sectors and themes like US technology or China or whatever, uh, EVs or chip manufacturers, etc. Whatever you want. So biotechnology. So all that options you can get, and that is easily available directly if you're sitting out of Europe and investing via these mutual funds and ETFs. So, what would be the risks of this approach? Risks are fairly straightforward. First and foremost, the hedging cost. I said the FX exposure of the euro versus the global currencies are hedged, but that comes up with a cost, obviously. So that's like what half, 1.5% annual will be the cost. So we just saw that the euro rupee cost is around 3%. This against the dollar is slightly less, or against the, let's say, AUD or SGD or any of the other currency slightly less, but that will still be there. Not that it's not there, it will still be there. So that will reduce returns a bit. And performance in the fund as such, if you are investing in active funds, then you obviously are exposed to fund manager risk. This can be mitigated by buying passive funds which invest globally. That's a fairly straightforward thing. It's not difficult to implement. But in terms of complexity, there are a lot of funds that you can look at, and so it's something that more complex and that to balance it out compared to doing something else or investing directly in Europe. So those options are there. Here's I've picked up one particular fund. This is a developed market fund. It's an accumulating fund, so it does not work with dividends. Euro denominated, and it's available from multiple European stock exchanges, which you can buy directly as an ETF. So this is there, and I've again provided the returns against the S&P 500, etc. So you can have a look at what the returns would be. So if these are the three options, then for whom which option should be taken? So it basically depends on risk appetite, time horizon, and return expectations. So what kind of risk you're planning to take, how long you'll be investing, and what kind of returns are you expecting? So if risk tolerance is very high and the time horizon is long, as said in the beginning, then investing directly in India would make a good amount of sense. But you need to keep in mind that you're now exposed to single country and single currency risk. So that's there. If you want a low risk, steady approach, then European markets offer stability. There's no FX risk, but the returns are obviously lower. Third option is one of the best options is since you're getting good amount of diversification and moderate risk while avoiding forex issues, the global fund would be a good option. So it all comes down to personal preferences and goals. If you want to blend the approaches, so you can obviously allocate a portfolio along these three options to optimize the risk return that you're looking at. So that's everything. Thank you all for listening to this presentation, and I'll see you all in the next one. Bye bye.